Welcome back to the deep dive. We are here to take a challenging stack of sources articles, internal memos, analyst reports, and really just cut through all the complexity to understand the core investment thesis.
And today, we are wrestling with NIO Inc.
We really are. This isn't just another easy stock. It is, I think, maybe the most polarizing and complex investment case operating globally right now.
It's a classic divergence study. I mean, you're pitting hard operational success against just brutal market skepticism.
Absolutely. So as of November 21, 2025, the stock is trading around, what, $5.29?
That's right. And it's seen this massive erosion, losing close to 19% of its value in just the last 30 days.
And the market narrative is pretty clear, right? They see a distressed Chinese hardware manufacturer.
Totally. Drowning in a price war, reliant on dilutive financing, that's the bear case in a nutshell.
But then you look at the actual operations, the reality on the ground, and the picture is just, it's startlingly different.
It is. They just posted an astonishing record in October.
40,397 deliveries.
I mean, that's nearly a doubling. It's a 92.6% year-over-year increase.
So how can a company priced for failure deliver that kind of massive scale?
And that is the contradiction we have to resolve today. Our mission, really, is to apply these stringent principles of value investing, think Graham and Buffett, to figure out if NIO is a value trap.
Right. Is it cheap because the business is just fundamentally breaking?
Or is it a profoundly mispriced compounder? We've got to find that ignored margin of safety.
And that margin of safety, like our sources are suggesting, seems to lie outside the car's chassis itself. We have to focus on the high-margin, sticky assets that the market is just completely dismissing right now.
Assets that justify a technology multiple, not a manufacturing one.
Okay, so what are we talking about specifically?
We have to dig deep into two pillars. First, that enormous power swap network, which is rapidly evolving from a cost center into a real revenue-generating energy utility.
And second,
the high-margin potential from licensing their own proprietary chip technology, the Shenji chip.
And crucially, we also have to factor in the geopolitical risk that's priced in and why a specific November 2025 trade shift, this tariff reduction, might have just invalidated that current $5 valuation.
Exactly. So to structure this, we're going to dive deep into 7 key chapters.
We're looking at the business model, management discipline, financial health, then market sentiment, ownership, risk, and finally, a valuation conclusion.
Let's unpack this.
Part 1, and chapters 1 to 3, business, management, and financials. Chapter 1, business understanding. Okay, so when you're analyzing any investment with a value framework, you have to start with a moat.
Right. Does the business have some kind of enduring competitive advantage that protects its returns?
For years, analysts just dismissed NIO's network. They called it a cash sink.
Just billions of dollars of holes dug in the ground.
Exactly. But the source materials we have point to what they're calling the blue sky moat concept, which is this vertically integrated ecosystem.
And that vertical integration is non-negotiable in the Chinese market. Pure auto manufacturing, it's just a commoditized, low-margin bloodbath.
So NIO realized they couldn't just build luxury cars.
No, they had to own the infrastructure and the core technology. So the competitive moat now is really made up of 3 distinct parts.
Which are?
The tri-brand strategy, the energy moat, and then technological sovereignty, which comes from their own silicon.
Let's start with how they solved their volume problem, this luxury ceiling. How does this tri-brand strategy stop them from just diluting the premium NIO image?
Well, it's just smart segmentation. The core NIO brand, it maintains its position as the premium and luxury flagship.
So we're talking cars priced above, what, RMB 300,000?
That's right. And this brand is critical for maintaining that prestige, that pricing power, because even when the overall EV market tightens up, the wealthy segment stays relatively resilient.
And we have proof of that, right? The ES8 refresh.
We do. It achieved 10,000 deliveries in only 41 days in 2025. That shows affluent consumers are still willing to pay a premium for that whole ecosystem experience.
But you can't get scale and cost absorption with just the premium line.
You can't. And that's where ONVO or Ladao comes in. This is the volume play. This is their strategic attempt to build the cash cow.
So ONVO is aimed squarely at the mass market.
Precisely. Their main target is the Tesla Model Y with the L60 model. But the real standout success, the one that gave them the scale for that October record, is the L90 SUV.
L90Q.
It consistently hit over 10,000 monthly deliveries for 3 straight months leading into the 4th quarter. This validation is key.
And how much did ONVO contribute to that big October number?
ONVO put up 17,342 units of that total, 40,397. So they've proven they can compete in the volume segment without wrecking the luxury NIO brand equity.
Okay, and then the third brand, Firefly. This one seems to be aimed almost entirely at their global ambition.
It is. It targets that RMB 100,000 to 200,000 segment.
So a much lower price point.
A much lower price point. Firefly is the long-term, high-volume export strategy. By using a distinct brand, they can create smaller, urban-focused cars designed for high-density markets like Europe and Southeast Asia.
And the source material mentioned something crucial here about right-hand drive models.
Yes. They're preparing right-hand drive models for markets like the UK, Thailand, and Singapore for 2026. This is their vehicle for global volume growth. It lets them avoid cheapening that main NIO luxury image when they enter these entry-level segments abroad.
That makes a lot of sense. But the ability to sell cars anywhere, let alone globally, it hinges on more than just the car. It's the energy ecosystem supporting it.
It is. So let's shift to the energy moat, because this is where the market's misunderstanding is probably the greatest.
Right. Analysts used to see 3,400 power swap stations as just a massive liability.
$3 billion worth of holes in the ground, like we said. Now they're realizing it's a genuine utility network. The scale is immense.
What are the numbers on that?
Over 97,000 battery swaps every single day, and 90 million cumulative swaps by late 2025. That scale creates a powerful customer lock-in through their Bears model.
Okay, Bears, battery as a service. Let's stay on that for a second. It's more than just a recurring revenue stream. How does that model change things for the customer and for the company's balance sheet?
Well, for the customer, you're fundamentally subscribing to energy. You're not owning the most expensive, most depreciating component of the vehicle, the battery.
And the 3-minute swap is the hook, the convenience.
That's the hook. For NIO, this structure lets them manage the battery liabilities centrally. But more importantly, it creates this sticky, predictable revenue stream that insulates them a bit from the cyclical nature of new car sales.
So what's in that revenue stream? It's not just the electricity.
No, it covers the energy used, plus a pretty substantial infrastructure premium for the convenience. It's like a high-speed charging subscription on steroids. And that predictable revenue justifies a higher valuation multiple than a traditional cyclical automaker.
But the real transformation, the thing that flips the script, is this virtual power plant, or VPP, opportunity. The batteries aren't just sitting there waiting.
Exactly. They're utility assets. And this is where the regulatory structure in China gets really fascinating.
How so?
In key areas like Chongqing, the local grid regulations let these massive caches of stored energy actively participate in load balancing.
So the station batteries charge up when power is cheap.
Right, during low off-peak demand when electricity costs next to nothing. Then, when the grid experiences peak demand, instead of just waiting for a car, those batteries can discharge power back to the grid for a premium.
And that completely transforms the infrastructure from a purely depreciating asset
Into a dual-purpose asset that generates revenue directly from energy arbitrage. You're not just writing down the asset value anymore, you're earning from it.
Okay, so that helps mitigate the capital burden. How long, realistically, until that VPP revenue can offset the depreciation and maintenance on these stations?
That is the critical question for institutional investors. Based on the operational data we have from Q3 2025, the VPP contribution, when you combine it with the Bayes subscription fee, is projected to cover over 60% of the network's O&M costs by mid-2026.
Over 60%.
And if that standardization effort succeeds, sharing the CapEx with partners, that figure could accelerate pretty quickly, moving NIO power toward being a net positive contributor, not a cost center.
And speaking of standardization, licensing this proprietary swap tech seems like a masterstroke to scale without just bleeding cash.
Oh, absolutely. The partnerships with major OEMs like Changan and Geely are pivotal.
They realize they don't need to own every station.
No, they just need their technology to be the industry standard. This lets them collect high-margin licensing and servicing fees from competitors, sharing that massive capital expenditure required to build out the network, and that just accelerates the network effect and solidifies the moat.
Let's move to the final pillar then. Technological sovereignty. Controlling your essential inputs is a classic Buffett principle. The launch of their own 5mm autonomous driving chip, the Shenji NX9031, seems like a major step here.
Vertical integration in these high-risk, high-tech sectors is paramount, especially for supply chain security and cost control. The Shenji chip isn't just about having an in-house chip. It's about a massive performance improvement and consolidation.
Consolidation, what do you...
A single Shenji chip delivers a four-fold increase in computing power compared to what they had before. And crucially, it replaces four separate NVIDIA or NX chips.
One chip replaces four. So how does that single change translate directly into the margin expansion we're seeing? We heard a figure of around $1,400 per vehicle.
That RMB 10,000 or 1,400 US dollars saving per vehicle is a direct cut in the bill of materials. To see the systemic impact, just extrapolate that out.
Okay.
Based on the October run rate of over 40,000 units a month, that translates to about $56 million in monthly savings on chips alone.
It's $56 million a month.
Or nearly $670 million annually once they get full integration across all the brands. This isn't some theoretical margin improvement, it's actual cash saved hitting the gross margin line in late 2025 and into 2026.
But we have to be critical here. I mean, producing a 5-nanometer chip is incredibly sophisticated. It requires foundries like TSMC. Are those savings realized right away, or is there a ramp-up period where low yields eat into that benefit?
That's exactly the right question to ask. The initial yields of any 5-millimeter production run are notoriously low, so the average unit cost starts high.
Right.
However, by late 2025, NIO had achieved enough scale and optimized their process to move into mass production with competitive yield rates. The cost benefit is now structural.
So the risk shifts.
The risk shifts. You move from relying on NVIDIA's pricing volatility to relying on steady allocation and yield quality from your foundry partner. But the key is the margin is now internal, not external.
And the final piece of this Shenji puzzle is the licensing revenue. This B2B arm is what could fundamentally justify that higher technology valuation.
It does. By licensing this high-performance silicon tech to other chip makers, they create a high-margin revenue stream that's completely detached from the capital-intensive business of making cars.
It's a buffer.
It's a substantial financial buffer against automotive hardware margin compression. If the Shenji chip becomes recognized as best-in-class for certain ADS tasks, that licensing revenue could grow exponentially and be valued at software multiples, 10x, 15x sales, which the market at $5.29 is completely ignoring.
Objector 2. Management evaluation. In any turnaround story, the quality of the management is, well, it's arguably more important than the asset base itself. For years, CEO William Lai was branded the visionary spender, just obsessed with growth at any cost. But the operational realities of 2025 seem to have forced a major maturation in how he allocates capital.
We're seeing a really profound shift. It's moving from growth at all costs to sustainable survival. The internal shift is formalized in what they call the vision action upgrade communications.
And in those, the focus moved from raw top-line growth to what?
To solvency and efficiency metrics.
The clarity of the management directive is pretty striking. There's a quote, "Profitability in Q4 is a must." That's not a suggestion, it's a mandate.
It signals a firm commitment to institutionalizing efficiency. But let's challenge that a bit. How do we know this discipline is coming from foresight and strategic change, and not just because they, ran out of cash?
That's a fair challenge. If they were truly distressed, we might expect to see chaotic fire sale launches of new products.
Exactly.
But the sources point to specific, rational decisions that suggest genuine discipline.
Right. Look at the delay of the ONVO L80 launch. They pushed it from late 2025 into the first half of 2026. If management were panicking for Q4 revenue, they would have rushed that launch.
But they didn't.
Instead, they prioritized manufacturing capacity for the high-demand, high-margin ES8 and the proven volume leader, the ONVO L90.
So that shows rational prioritization. They're maximizing the profitability of existing successful products rather than rushing a new one just to pad the sales number.
It suggests foresight, not panic.
This managerial candor is also a key principle for a long-term compounder. In his internal letter for NIO's 10th anniversary in November 2025, Layla was remarkably grounded.
He was. He described the journey as a marathon on a muddy track.
That's a significant departure from the typical, euphoric tech CEO speech.
It is. He acknowledged that the market is entering a war of attrition and that only a few outstanding companies will remain standing.
That grounded view prepares the company and investors for the reality of the competition ahead. It suggests the management team really understands the severity of the challenge.
And this disciplined, long-term focus on survival and profitability is precisely what value investors want to see when they're betting on a turnaround.
It proves they're focused on optimizing their internal capital structure and operations.
rather than just solely relying on external capital markets. This is the difference between a successful turnaround and a value trap.
Like and subscribe to Stock Analytics AI, Chapter 3, Financial Health.
Okay, now we have to tackle the technical reasons why the market is so skeptical. And that's primarily the balance sheet.
This is the ultimate paradox. Operational liquidity versus technical distress.
We can't ignore the major red flag.
No, we can't. The shareholders' deficit, or negative equity, it stood at about 1.1 billion RMB as of June 30, 2025. For the average investor, negative equity just screams imminent bankruptcy.
And if this were a liquidation play, right, if NIO just suddenly stopped operating, that negative equity would mean liabilities exceed assets, which would justify the low stock price.
It would.
But why is this different for a growth company like NIO?
It's a crucial structural difference. This deficit isn't primarily from recent catastrophic operational losses or bad debt. It's rooted in accumulated historical deficits.
I mean, the decade of massive R&D spending and the huge capital outlay, the CapEx required to build that energy network, and the initial manufacturing plants. These are sunk costs that are meant to generate high future revenue, especially from the IP and service side.
So it's a deficit that was caused by strategic investment into their moats, not by ongoing operational incompetence.
Exactly. The company is classified as a going concern, so the critical metric for their survival and for this turnaround plan isn't historical book value, it's current operational liquidity.
And their cash position gives them a pretty substantial runway.
Extremely substantial. As of Q2 2025, they held 27.2 billion RMB. That's roughly 3.8 billion US dollars in cash and equivalents.
That provides a multi-year buffer.
It does, even accounting for continued high investment in R&D and expansion. The negative book value is a lagging indicator of historical spending. That $3.8 billion cash pile is the leading indicator of their future survival capability.
So the path to neutralizing that negative equity starts with the margin trajectory. Are the unit economics actually improving?
The trend is robust. Q2 2025 gross margin hit 10%, up sharply from 7.6% in Q1. Vehicle margin was a little better at 10.3%.
The velocity of that improvement is what's exciting.
It is.
We've already highlighted the drivers, but let's just reiterate how those two factors work together to drive the margin expansion.
Okay, so first you have the scale effects from the ONVO brand, providing massive volume, which absorbs fixed costs across the board.
And second,
The cost reductions driven by that proprietary Shenji chip integration, which, like we established, provides a direct $1,400 saving per vehicle.
and this synergistic relationship is what's projected to push them toward that goal of double-digit margins in Q4.
Exactly. And that projected Q4 margin is critical because it makes the final step to net income break even in 2026 mathematically achievable, especially when you pair it with the Q3 revenue guidance.
What was that guidance again?
Management guided Q3 2025 revenue to between 21.8 billion and 22.9 billion RMB.
Which is a staggering jump year over year.
It's a 40 to 47% year-over-year jump in deliveries. They're targeting between 87,000 and 91,000 units. If they can execute that growth while hitting those double-digit margins, the break-even inflection point becomes a reality.
Which should trigger a massive re-rating from the market.
It should.
Now, we have to address the persistent headache for shareholders: dilution and debt overhang.
Yeah.
This is the silent killer of EPS growth.
It really is. It's the cost of financing that high growth. The weighted average shares outstanding, diluted is high. It reached 2.23 billion in Q2 2025.
And NIO relies heavily on convertible notes.
They do. It's debt that converts to equity if the stock price rises above a certain threshold. And while it's efficient financing, every time the stock price recovers, the conversion of those notes into new shares dilutes the earnings per share for existing holders. It's a constant headwind that dampens the enthusiasm for a recovery.
We also briefly mentioned WACC earlier, the weighted average cost of capital estimated at 6.14%. Why is that number significant for a high-risk company like this?
Well, for a company in such a volatile sector, dealing with geopolitical risks and historical negative equity, a 6.14% WACC is actually highly competitive.
What does that imply?
It implies that the market is factoring in a relatively low cost of debt. And that's thanks to institutional confidence, like the Abu Dhabi investment, and the efficiency of their convertible notes.
And if their WACC were higher, say 8 or 10%.
It would mean their hurdle rate for projects would be too high, making future expansion prohibitively expensive. The 6.14% WACC tells us that despite all the chaos in the stock price, capital providers still view the business model as viable, and that's a powerful vote of confidence.
And for $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership Risk, and Final Conclusion.
Chapter 4, Market Sentiment. Okay, so if the financial trajectory and the asset base are both pointing up, the only reason the stock is priced at $5.29 is external skepticism.
It has to be, which means we have to look closely at institutional activity and, most importantly, geopolitics.
The single largest driver of the low valuation has been this China risk premium.
Right, the fear that regulatory or geopolitical tensions could just wipe out the investment. But the massive underpriced catalyst right now is the November 2025 geopolitical pivot, the U.S.-China trade agreement.
Let's get into the specifics of that agreement, because the stock price seems to be completely ignoring it. What were the previous tariff levels? And what does a 10-point reduction really mean structurally?
So previously, tariffs on key Chinese imports, particularly finished vehicles and specific supply chain components, they often hovered around 25% or even higher.
Which makes U.S. market entry basically impossible from a cost perspective.
It's prohibitive. The November 2025 agreement stipulates a reduction of tariffs on specific Chinese goods by 10 percentage points effective November 10th.
So a product that had a 25% tariff now faces 15%. How does that affect NIO's global growth narrative, especially for that Firefly brand?
It fundamentally uncaps their total addressable market, their TAM. NIO already has a headquarters in San Jose. They've been hiring U.S. staff.
Okay.
So let's take a Firefly model priced around, say, $20,000 US. The old 25% tariff adds $5,000. The new 15% tariff adds only $3,000.
That $2,000 difference is massive for an entry-level EV.
It's huge for competitiveness. It lets them enter the U.S. market at a far more competitive price point.
And the stability aspect of the deal is just as crucial as the reduction itself.
Absolutely. The deal suspends any further reciprocal tariff hikes until November 2026. This gives them a 12-month window of predictability.
Which for a manufacturer building multi-year supply chains is worth billions.
Exactly. It tells global institutions that the worst-case scenario for global expansion is likely off the table for the immediate future.
So if the macro picture is improving that dramatically, what are the institutional flows telling us? Is the smart money accumulating at these low levels?
Q3 2025 activity shows a classic split, which usually indicates a bottoming process. We saw definite accumulation.
For who?
The quantitative giant 2 Sigma, they re-entered the position with a purchase of about 3 million shares. Vanguard, which is long-term patient capital, increased its position by over 14%. JP Morgan also increased exposure across the whole EV supply chain.
Which suggests broad confidence in the sector.
It does. But the UBS data provides this fascinating psychological disconnect.
What happened there?
It's the definition of a capitulation bottom. UBS analysts upgraded the stock to a buy with an $8.50 target, justifying the thesis we're talking about.
Okay.
But at the same time, their trading desk slashed its institutional position by 59%.
So the research arm thinks it's cheap, but the traders sold into the fear.
Exactly. And that divergence often indicates that the weak institutional hands have finally exited the stock just before the fundamental story takes hold. It paves the way for a sharp recovery when the narrative shifts.
Okay, finally, let's look at the short interest dynamics. Given the skepticism, a lot of traders are betting against this company.
The short interest is currently around 11.26% of the float. That's a significant contingent betting on a collapse.
And what's the risk for them?
If Q3 or Q4 earnings confirm these efficiency gains, the double-digit margins, the path to profitability, that news, combined with the geopolitical tailwind, creates a high potential for a short covering rally.
So those short sellers would be forced to buy back shares.
Rushing to buy them back, which would add explosive upside to any fundamental price recovery.
Chapter 5. Ownership structure. Who controls the ship always matters, especially when you're navigating turbulent waters. Let's look at management alignment and the corporate structure.
Management alignment is strong. Founder and CEO William Lai is still the largest individual shareholder.
And he retains a controlling voting interest.
He does. And that's crucial because it aligns his long-term wealth directly with the long-term strategic success of the company, the multi-brand rollout, the VPP utility development, all that expensive R&D. He's shielded from short-term pressure to abandon those projects.
The corporate structure, though, has been complicated in the past by the involvement of state-owned enterprises in NIO China. Has that been resolved for ADR holders?
Yes, substantially. There was a recent positive development where NIO Inc. increased its stake in NIO China to 91.8%.
That's a critical move towards simplification.
It is. For ADR holders who invest in the U.S.-listed entity, this streamlining provides a much cleaner, more direct claim on the operational assets and results on the mainland. It reduces that perceived risk of fragmented ownership.
But the shadow of dilution remains. We have to reiterate that even with a cleaner structure and aligned management, any significant recovery in the share price is likely going to trigger the conversion of those convertible notes.
And that impacts EPS for everyone. It's the inherent trade-off. You're buying into a high-growth, high-risk turnaround, and the price of that turnaround is a higher share count upon successful execution. Investors just have to factor that future dilution into their intrinsic value models.
Chapter 6. Risk Assessment. Value investing is as much about managing risk as it is about chasing growth. We've established the moats and the upside, but now we have to systematically review the primary threats.
Right.
Let's start with the most critical internal risk, execution failure.
This is the highest probability, highest severity internal risk, and the failure is twofold. First, missing that mandate of Q4 profitability is a must.
What happens if they miss that?
If the Q4 numbers show margins haven't hit double digits, it implies the scale effects from ONVO and the cost savings from Shenji are either delayed or just not enough.
And the second part of that failure?
If they miss that target, the $3.8 billion cash pile suddenly looks a lot smaller, which would likely force a highly dilutive emergency capital raise in early 2026. This would confirm the value trap thesis and crush the stock, regardless of the underlying technology.
So what are the key performance indicators, the KPIs, that we need to watch most closely to gauge this risk?
Beyond the margin number itself, we need to see sustained volume from the ONVO brand holding above 15,000 units a month.
Okay.
We also need explicit confirmation in the Q4 earnings report that $1,400 per vehicle saving from the Shenji chip is being realized, and that the VPP strategy is generating incremental revenue that's being clearly segmented on the income statement.
Failure on any of those three metrics significantly raises the execution risk.
It does.
Okay. Moving to the external threat. The one thing management can't control, geopolitical reversal.
The whole investment thesis is dependent on the stability from that November 2025 trade agreement. The risk of reversal is moderate, but the severity would be catastrophic.
So if the U.S.-China relationship deteriorates again.
Right. If a new political administration reverses the tariff reduction or imposes new sanctions targeting Chinese EVs, the global growth narrative is just instantly severed.
And the stock would re-rate back to a deep China-only discount.
It would, potentially wiping out a third or even more of the current market value. The reaction is always swift and brutal because it impacts the long-term terminal value and global market access. It invalidates all the growth assumptions.
Okay, finally, the competitive landscape, the war of attrition in China. This market is becoming brutally zero-sum.
The competition is terrifying. The entry of tech giant Xiaomi with their SU7 sedan caused a massive shockwave.
Right. Surveys showed Xiaomi quickly overtaking Tesla as a top EV choice in China.
Just on hype and pricing, the sheer volume of Chinese manufacturers means this is an environment where only a few will survive.
So how does NIO's counter strategy move beyond just brand positioning?
Their defense relies on high switching costs. While Xiaomi and Tesla compete on price and performance, neither has that superior infrastructure of the 3,400 power swap stations.
So once the consumers lock into the back ecosystem,
the cost and inconvenience of switching to a non-swappable vehicle are substantial. ONVO is the direct price counter strategy, but the swap network and the premium service experience are the fundamental differentiators that give them superior customer retention.
And when you compare the assisted driving tech NIO's NAD versus Tesla's FSD, where's NIO's subtle moat?
Tesla still leads in raw robotaxi ambition for sure, but NIO's moat lies in vertical integration through the Shenji chip, which allows for hyper-specialized optimization and local adaptation.
What do you mean by local adaptation?
Chinese consumers place a high value on assisted driving features that can flawlessly navigate complex local road conditions. Things like unmarked lanes, high scooter traffic, dense urban environments.
An NIO system is engineered specifically for that.
Exactly. Because it's engineered for Chinese dynamics and optimized by their own silicon, it offers a perceived superiority in domestic reliability that foreign competitors really struggle to match.
Chapter 7. Conclusion. So we've built the case. Operational scale, margin improvement, proprietary tech, and a geopolitical tailwind. Now, the synthesis. Why is the valuation so disconnected?
It's a classic valuation dislocation driven by fear and inertia. At the current price, the stock is trading at a price-to-sales, or PS ratio, of about 1.0x.
Which for a company growing at this rate is low.
It's unsustainable. With a market cap around $11.3 billion and projected 2025 revenues of $10 to $11 billion, that ratio is simply unsustainable for a company growing at 40+% year over year.
If we look at historical and peer comparisons, what should a company with NIO's assets and growth profile command?
Well, historically, NIO traded at PS multiples between 4x and 10x during its high-growth phases. Peer leaders like Tesla trade at 6 to 8 times sales.
And even smaller competitors.
Even much smaller, less differentiated competitors like XPeng trade at 1.5 to 2 times sales. The current PS of 1.0x explicitly prices the company for zero future growth and imminent bankruptcy. It's completely ignoring the monetization of its IP and energy assets.
Okay, so let's approach this from the discounted cash flow, the DCF perspective. If we assume the turnaround succeeds, what does the present value of future cash flows imply?
Well, DCF is always highly sensitive, but the inputs here are compelling. We noted that competitive WACC of 6.14%. Analysts are projecting substantial revenue growth, about 21.6% annually through 2027.
So what's the conclusion?
If we assume management hits its margin targets and achieves a modest long-term terminal growth rate of just 3%, the present value of future cash flows, critically, including the high-margin licensing and utility service revenue, suggests an intrinsic value significantly higher than the current $5.29 price.
To establish a hard margin of safety, let's use the sum of the parts, or SOTP, valuation. We strip the company down to its core components and assign ultra-conservative, distressed multiples.
We have to defend these conservative multipliers. First, auto manufacturing and sales. We use a severely distressed multiple of just half a time projected 2025 sales.
Which is typically reserved for companies facing existential crises.
It is. At 0.5x sales, this segment is valued at approximately $5 billion.
Okay. Next, NIO Power, the energy grid. How do we justify valuing a massive yet loss-making infrastructure network at $3 billion?
We value it not as an automotive cost center, but based on precedent valuations for energy storage and charging utility companies. We focus on replacement cost and projected VPP revenue. The infrastructure is just too large and strategic to be worth zero. $3 billion is a highly conservative estimate for a network operating 90 million swaps.
And finally, the technology IP, the Shenji chip and software. Given its high-margin B2B potential, what's a conservative floor there?
Based purely on the estimated revenue potential from the Shenji licensing arm over the next 2 years, we assign a conservative floor of $2 billion. It's a technology multiple, but a very low one, reflecting the early stage of that external monetization.
So $5 billion for auto, plus $3 billion for power, plus $2 billion for the IP equals $10 billion.
And that $10 billion figure essentially justifies the current market cap of $11.3 billion. The implication is profound.
You're paying asset value.
You're paying asset value, which establishes a fantastic margin of safety based on distressed multiples. You're getting the full upside of the operational turnaround, the multi-brand success, the margin expansion, the Shenji chip cost savings, and the geopolitical tailwind for free.
And this is the essence of the asymmetric opportunity. NIO is not a cigar butt waiting to burn out. It's a technological leader in the middle of a transformation.
The investment thesis relies on this specific asymmetric payout profile. The fundamental catalyst for a re-rating will be those Q3 and Q4 2025 earnings, confirming the path to profitability and giving concrete details on U.S. market entry.
And the moats are strong.
Very strong. High switching costs via BOS and the proprietary Shenji chip ecosystem. This is what drives the dislocation between the current price of $5.29 and the estimated intrinsic value, which conservative analysts are pegging between $8.50 and $10.
The market remains fundamentally fixated on the negative history, the cash burn, the negative equity, and is completely failing to recognize these powerful forward indicators: record scale, margin expansion, and the monetization of the underlying tech stack.
And the geopolitical thaw just uncaps the global growth potential for that final brand pillar, Firefly.
So here is a final provocative thought for you, the listener, to mull over.
We discussed the successful licensing of the swap technology to companies like Chang'an and Geely. If NIO successfully establishes its battery swap system as the de facto industry standard in China, forcing broad adoption across the entire domestic automotive market, how quickly does the market have to re-rate the valuation of NIO power?
Does it remain a hardware cost center?
Or does it transform into an infrastructure utility company, justifying energy utility multiples, which are often far higher and more stable than automotive multiples? The answer to that re-rating potential is the true source of the asymmetric return.
A truly fascinating prospect for a company that's currently priced as if it were on the verge of total collapse. That is it for this deep dive into the complex investment case of NIO Inc.
If you appreciated this detailed breakdown of the business and financials, make sure you like and subscribe to Stock Analytics AI.
And for $4.99 a month, you can get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. We source our analysis from AI research source materials and want to remind you that this discussion is for informational purposes only. It is not financial or investment advice. Please conduct your own due diligence before making any investment decisions.